Good day, ladies and gents. In this video we're gonna be continuing with the Forex Terminology. We're gonna continue from where we left off last time. So today we're gonna be looking at the bulls versus the bears as our fixed point. So let's get to it. Bullish versus bearish is the essence of the market, the driving forces of the market. Bullish means that the market is moving in an uptrend or has a short-term price movement up. Okay, and then bearish means that the market is in a downtrend or short-term price movement down. So let's have a look on the chart what that means. So that means if you have a market that is moving upwards like this one, like there, that is what we call a bullish movement or a bullish market. The bullish market, or the bulls are in control. The bulls are in control since the market is in an upward movement. Yeah. So if the market is in a downward movement like this one here, it is a bearish move. That means the bears are in control. So that is a bearish market. Or the bears are in control. So that is the difference between the bulls and the bears. I hope you can see the difference between the two. This is a bearish market, and then this is a bullish market because the market is going up. Bullish is up, bearish is down. Okay, then let's move on to the second point, which is pips versus points versus ticks. What's the difference? Okay, point, tick and pip are terms traders use to describe price changes in financial markets. While traders and analysts use all three terms in a similar manner, each is unique in a degree of change it signifies and how it is used in the markets. We're gonna first have a look at a pip. A pip is actually an acronym for percentage in point. A pip is the smallest price move that an exchange rate can make based on the market conversion. Most currency pairs are priced to 4 decimal places, and the smallest change is the last fourth decimal point. A pip is the equivalent of 1/100 of 1% or more, or 1 basis point. For example, the smallest move the USD currency pair can make is 0.001 or 1 basis point. So with that, I just want to quickly jump to a tick. The reason I'm jumping to a tick is because a pip and a tick are a similar thing. They are a similar thing. Let's have a look what the definition of a tick is. A tick denotes a market's smallest possible price movement to the right of the decimal, going Going back to the IG index example, if this index elected not to shift the decimal place to use points, its price movement would be tracked in increments of 0.001, which is what we similar from what we which is similar to the example which they made there, of the USD currency pair. Of the smallest move the USD CAD currency pair can make is 0.001. So you can see a pip and a tick, they are similar. So let's have a look. This is where the measurement of price is, remember. So when they're referring to a pip and a tick, they are referring to the numbers on the right hand side of a decimal. The 1 point, as you see, it's 1.36 what. So the smallest move, which is made by the last number here on the right hand side of the decimal, that is where you find your point and your tick. They are the smallest moves that the market makes. That's your point and your pip and your tick. Then let's have a look at what a point is. A point is the largest price change of the three measurements and only refers to changes on the left side of the decimal, while the other two include fractional changes on the right. An investor with shares in company ABC stock might describe a price increase from $125 to $130 as a 5-point movement rather than a $5 movement. So a point, this is what a point is. The number on the right hand side of a decimal, on the left hand side of a decimal. On the right hand side we have our pip and our tick, and then on the left hand side we have our point. That means the ticks and the pips are the ones that add up to make up 1 point. The point is the biggest movement, and the tick and the pip are the smallest movement on the right of the decimal. Okay, and then we're moving on to market structure. Market structure in forex trading market structure in forex trading or price action is a movement of price on price chart. As price moves in a fractal nature, this demonstrates a price pattern of a series of higher highs and lower lows, creating an uptrend market. Or the opposite is with lower highs and lower lows, or the opposite with lower highs and lower lows, being a downtrending market. Market structure in forex trading can also be price pattern, which relates to patterns such as the bullish and the bearish flag. So we're gonna have a look at patterns after we are done with the structure. So when they're referring to structure, this is what they are referring to. I want you to have a look at this market over here. I'm gonna measure these highs with the green line. This one, those are gonna be our highs. High here, another high over here, another high over here, another high over here. Right. Then we're gonna go ahead and measure our lows. over here we have our lows. Just want to change the color of this so you can see which is which. Alright, there we have our loops here. There we have our loops. Then I want you to have a look at this of how market structure is. We have our high over here, and then let's say over here we have our first low over here. Yeah. Okay. Okay, so if you have a look at this, from this low to this low, that low is low, that low is higher than this low over here. So this means this one qualifies as a higher low because it's higher than the previous low that was made. So it's a higher low, which is abbreviated HL. That is our higher low. Okay, and then if we have a look at this high over here, this one, it's higher than the previous high that was made. So that means it's a higher high. It's a higher high, which is abbreviated double H. So now if you have a look at the price, that's what it keeps doing. It keeps on making higher lows and higher highs. Higher lows and higher highs. That's higher low over here. And there's another higher high over there. Before the higher high, we had a higher low. So this over here is what we call a bullish market structure, because the market is moving upwards. So this is a bullish market structure. It's a bullish market structure. That's what you are looking at over here. The reason it's a bullish market structure is because it keeps on making higher highs and higher lows. Higher highs, higher lows, higher highs, higher lows. So for a bearish market structure, it's the opposite of what's happening that side. There's our bearish market structure over here. First we have a high. You have a high over here. We have a high over here. Then we have a low. My PC is a bit slow, guys. I don't know what's happening as the devil is working overtime. see what the market goes on to do. Because this one is in a downtrend, then that means we're gonna be making lower lows. See, the market is making lower lows. We have a lower low, which is abbreviated LL. Then here the market moved from this high and it made another high, but then that high, if you look at it, it's lower than the previous high. It's lower than the previous high, so that means this one qualifies as a lower high because it's lower than the previous high. So we have a lower high, which is abbreviated LH. So if we have a look at the market, you'll see it keeps on doing the same thing. It's making the reason for that is because it's trending downwards. So when it's in a downwards trend or a bearish trend, then you're gonna be making lower highs and lower lows. But then if we are in a bullish trend, the market is going upwards, then you're gonna have higher highs and higher lows, showing their strength to be bullish. So this is a bearish market structure, since we're making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So this is a bearish market structure. Bearish market structure. This is our bearish market structure. See? So this is the difference between a bullish market structure has higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, while a bearish market structure has lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. So that's how you get your bearish market structure. Okay, so for now I think I'm going to leave it there. I'm gonna continue with reversal patterns, continuation patterns, and other forex terminology, just to wrap up the terminology.